All right, welcome everyone. Ooh, lots of people here. Hello, hello. We had some excitement right before we went live with this thing. I accidentally kicked my headset off and we couldn't hear me. So we're here, and right off the get-go, let's do this. We are going to show one of my very favorite slides. It's one that Paige designed, and it's called the compliance disclaimer. And we'll look at this so everyone has enough time to read it. And I promise you the slides that I designed are going to be a lot more exciting than this one. But Nikki, everyone, I don't think anyone's ever met Nikki. Nikki's the proud product of Saluda, South Carolina, and a Clemson grad. And she recently joined us, a month or two ago, Nikki?
Yep, just a month ago.
Cool. And she stayed, which is an amazing feat. So let's do the give everyone a little bit more time to get in here, because I know some people were having trouble with the link. Do that little question, and then we'll get right into the presentation. Do I need to give it over to you? Do I need to go over to like poll questions? Yeah, maybe that's what I need to do. Okay, here we go. So on the right-hand side of your screen, you should see a little poll. And I thought this was kind of cute because today's topic is inflation. What was the interest rate on your first mortgage? 1% to 3%. Apparently, we have some first-time home buyers, because I don't think we've had 1% to 3% mortgages, not but for the last 5 years or so. 7% to 10% seems to be leading the way. It's almost like a horse race. I think I was at 5 1/4 my very first mortgage. But some of you probably have ties that are older than my first mortgage paper. I got some plus 10%ers. You know, that's Jimmy Carter-esque, late 1970s, early 1980s. Pretty even across the board, though. All right, cool. All right, we got a pretty good crowd. And, of course, this is going to get recorded. So if you have to get pulled in another direction, we'll send this out to you shortly thereafter. I'm going to end the poll, and it looks like 7% to 10% with a plus 10% shortly right behind it. So you guys were paying a lot of money on debt when you guys bought your first house. I could do another poll question. How much was your first house? And we'd probably laugh at some of those prices, especially if you lived in Charleston. All right, let's get to the presentation. Stop presentation. Okay, well, the presentation is already up. All right, beautiful, guys. So today we're going to talk about inflation. I think you've probably seen some of the headlines. I think you're probably starting to see it when you go out and you buy consumables. And in particular, we're going to cover what to do with money in an inflationary environment. A lot of individuals on this call already work with our firm. We've made a number of adjustments over the course of the last year as we've seen money supply increase. And some of the folks who just listen to the radio, tuning into this, hopefully you're able to walk away with a couple nuggets of information that you can use to better prepare yourselves. All right. You can't talk about inflation without bringing up money supply. And we use M2 here. M2 seems to be the most robust mechanism to determine how much money is in the system. And this little chart here shows M2 money supply from about 2017 up to 2021. And you can see there's been a 60% increase in money supply literally just over the last 4 years. And of course, that line pointing to the COVID response, that was about a 35% uptick in money within the system. I like to think of money supply almost as the snow within a snow globe. If you shake up a snow globe, naturally it looks all pretty and everything, but eventually all of that snow is going to flutter down to the earth. And it's going to pile up, and the businesses that are the very best at separating us from our money are ultimately going, and the people who are the best at separating us from our money are ultimately going to be the people who amass the most of that snow. Morgan Stanley's chief strategist, equity strategist, said back in August 2020, it's fair to say we have never, ever seen money supply growth as high as it is these last 4 years. So there's going to be repercussions for printing this much money and injecting it into the system. One of those repercussions is going to be inflation. I pulled this right from the Wall Street Journal headline June 10th, not but a week ago. U.S. inflation, the highest it's been in 13 years, prices surging 5%. That isn't even the half of it, though, because when they say prices are surging 5%, they're referencing the Bureau of Labor Statistics Consumer Price Index. So the good news here is if you're on Social Security, you're going to get a little COLA adjustment to the tune of close to 5% if inflation numbers stay where they're currently at. I've sounded off on many occasions, though, that the Consumer Price Index has been manipulated every which way. It doesn't include a lot of the things that we need and consume on a day-by-day basis. The things that jump right off the paper at you, though, are used cars and trucks. Look at that. Used cars up 30%. This might be the only time in the course of human history where it's desirable to be a used car salesman, because you literally don't have to haggle with customers. They literally just have to pay the sticker price and then some. Airfares, I know a lot of people, now that they've got their COVID vaccines and the world's opening back up, are starting doing those trips again. And they thought they were going to be getting greeted with cheap cruise tickets and cheap airline fares, but airline fares are up close to 25%. Fix your eye to the bottom of this slide, because these are things that are not factored into the Consumer Price Index, which we've seen a huge surge. And this is just over the last year, 1 year, May 2020 to May 2021. Furniture prices up 30%. Lumber prices were as high as up 400%. They've come down pretty precipitously, but they're still up over 300%. Appliances up 12%. Washing machines and dryers up 26%. Meats, God help us, the 4th of July is next week. Is it next week? No, 2 weeks from now. And everyone's cleaning their grill off, and meat prices are now up 8%. Gasoline, I don't need to tell you guys this. Look at what you're paying at the pump, up 50% right now. And then real estate median sale prices across the whole country, I pulled this from Y Charts, are up 16%. I know a lot of individuals are looking at their house price on Zillow. And then even some individuals are saying, hey, I'm going to sell my house because I can make a bunch of money off of it. Here's the problem there, folks. If you sell your house, you need to turn around and buy another house. So you're going to get hit with inflation on both sides of that transaction. But we're seeing it all across the board. And we just need to be conscious of what real inflation is happening and what the government is issuing when they talk about CPI. This was pulled from the New York Times. Mind the fuzzy, your vision isn't going. This is just a fuzzy slide. It talks about the cost of a sack of groceries between April 2001 and April 2021. So 20 years. And the difference is close to an increase of over 50%. Although I got to tell you, I don't know where they pulled these numbers from, because they said you can buy a loaf of bread for $1.50. I need to get Claire to shop at the same grocery store the New York Times is shopping at, because I don't think we pay $1.50 for bread, nor $4.91 for bacon. That's the cheap stuff. But you can see massive appreciation in prices right at your grocery store. So what do we own as investors during inflationary times? Or what we're not supposed to hold, right? What do we not want to be holding during inflationary times? Now, I know cash is king. And our messaging and our message to folks is we're relatively conservative investment managers because we work primarily with retirees. And it's imperative to have an emergency fund. It's important to have stores of stability and safety. And cash is one of those things. The problem we face right now in owning cash is when your government is diluting your currency by 60% over the course of the last 4 years, in essence, that means your dollar is 60% less valuable. So it might even be more dangerous sitting on gobs of cash than it is buying a technology stock right now. Certificate deposits, same story here. We've got low interest rates with a monetary supply that's getting injected unlike we've ever seen before. I saw a 5-year CD, if you go to NerdWallet or Bankrate right now, is only paying less than 1% per year. So literally lock up your money for 5 years and make 1% per year. I like what Paul Tudor Jones said last month. He basically said owning cash is crazy because your central bank has a vowed goal of depreciating your cash by 2% per year. It's in essence owning an asset that's just dwindling in your hands. The other one is bonds. You don't want to be a lender in an inflationary environment. And when you own a bond, you're lending someone money, whether it be a corporation or a municipality or buying a government bond, you're lending the government money. When you see inflation running at the pace that it's currently running at, you don't want to lock up your money in a long-term lending instrument, especially with interest rates as pathetic as they are right now. So I think if you're working with us, you'll notice, even though a lot of you are 60, 70 years old, and if you were to subscribe to modern portfolio theory that might be disseminated from like Vanguard or something, you're supposed to have a 60-40 stock equity blend. And I think you'll find our portfolios are very, very light on bonds. And when we own bonds, we own high yield bonds, we own short duration bonds, we own floating rate notes, treasury inflation protected securities whenever possible. So these are all things that in owning them, you might think you're being secure and being prudent, but you're in actuality losing money safely. So what are we supposed to own? Here's my guy, Jim Cramer. He did a podcast at the end of last year where he said, my inflationary handbook says buy gold, buy masterpieces, and buy mansions. Oddly enough, shortly after that podcast, he surrendered and bought Bitcoin, and the Bitcoin shot through the roof, which we'll talk about a little bit later on in the presentation. He has since sold his Bitcoin because he was worried about what's happening in China right now as I record this. So let's talk about what my inflation handbook tells you to own. Own assets. Don't lend people money. Don't sit on cash. Own assets. Obviously, the lowest hanging fruit asset is real estate. Now, some of you don't want to be a landlord, however. Some of you don't want to do business with a bank and take out a long levered loan. Donald Trump, love him or hate him, just played inflation like a fiddle recently. He refinanced a building that he owns in San Francisco and got a bank to give him $1.2 billion at a 2% interest rate. That's the type of stuff, if you're managing gobs of money, you want to do in an inflationary environment. You don't want to lend people money. You want to get people to lend you money at incredibly low rates. So if you don't want to be a landlord or you don't want to own real estate, one thing that you can do to double down on the real estate that you already own is do capital improvement projects. And that's a fancy word for saying redo your kitchen, or upgrade your bathroom, or redo the landscaping in your yard. And y'all know me, I'm always sounding out about spend your money, enjoy it, live an abundant retirement. This could be a way, if you're sitting on lots of cash or you're sitting on bonds, you can deploy that cash into your property's value. That's going to adjust your basis up higher because we've done a whole presentation on Joe Biden's tax plan. He's talking about getting rid of the step up in basis. And ultimately, you're not setting money on fire. You're just putting that money into your real estate. And your real estate is an asset. So if you ever come a time when you go to resell that property, or if you get taken out of that property in a box, you'll have a property that's more valuable. So maybe for some of you that have been hemming and hawing about upgrading your house, maybe this inflationary environment is a reason to do that. Now, you need to take note that lumber prices are up 300%. So if you're putting an addition on your house, that's going to cost a heck of a lot more. Metals, gold and silver. This has always been the inflation hedge. I think I saw gold is at an all-time high as people use it as a flight to safety. You'll notice our swan model has gold in it. Just like we're going to talk about with cryptocurrency, I've always looked at metals. I'm not the biggest fan of metals. They don't really pay interest or rent or dividends, so it's kind of a stagnant asset. But there's an element of scarcity there. All of the world's gold would fit into an Olympic-sized swimming pool. And when inflationary pressures hit us, people flee to it. So you want to have some gold and metals. I always recommend about 1% to 5% in those types of assets. Commodities, here again, just like gold and silver and metals and even cryptocurrency, there's a scarcity element to it. And that's why we're seeing such increases, because the input of things like appliances and some of the things I showed you on that previous slide are commodities. So commodity prices are going up. If you're going to own bonds, just like I talked about a minute ago, if you have to own bonds because you want to own some things that zig when the market zags, keep your duration as short as possible. When I mean duration, it means how long will it take for me to get my initial investment back with the interest payments that I collect? Or how long is the term of the bond that I own? Duration's a little bit different than term, but kind of the same principle there. You want your yields to be high. They're talking about a taper tantrum. The Federal Reserve, the way they're going to combat inflation is they're going to raise interest rates, which might bode well for new CD purchases and new bond purchases, but that'll be a really bad thing for individuals who own bonds. If you own high yield bonds, you'll be less susceptible to losses as they raise interest rates. And then finally, bonds that are linked to inflation. So I bonds, you can only buy like $10,000 per year of those. We use a fund called TIPS, TIPS, Treasury Inflation Protected Securities. These are bonds that pay a premium based off of whatever government issued CPI is. So government issued CPI was 5%. That means those bonds are going to pay an interest payment of 5%. I might go above and beyond that. We talked a lot about linked accounts, linked instruments. There's a brand new linked account that just hit shelves last week that I'm probably going to be doing a video news flash on because I think it's going to be up a lot of individuals' alley who are sitting on lots of cash. People who are sitting on cash but don't want to buy dividend stocks or commodities or tech stocks or cryptocurrency. They like the principal protected element of owning cash. Even though your principal is not protected because you could be losing purchasing power, you still see the same dollar amount that you put in that bank account, even if the government prints more money. So there are some other alternatives to cash that you can explore, which I'm going to be doing some follow-up information on. We're going to talk in just a moment about dividend stocks. This is something that I've been high on since probably about as soon as the government started printing money. It made a lot of sense to me. But certainly some of the slides that I'm going to show you actually just stole right from the presentation that I did back in January. I love dividend stocks, and I love companies that could increase their prices without you batting an eyelash. Think of a company like Johnson & Johnson, which we're going to talk about. If they raise the price of your deodorant or your toilet paper or your toothpaste, you're still going to buy that unless you're a really grubby person. You're still going to buy your toothpaste. There's nothing you can do about it. So they're going to be very protected from inflation. They're just going to pass that inflationary pressure onto their consumers, and their P&L should remain relatively constant. So we love companies that have the ability to do that. Some companies won't. Tech stocks, a lot of these companies, when you think of Amazon, Google, Netflix, Apple, Facebook, FANG stocks, they don't have a tremendous amount of capital input to run their businesses. The biggest fear with those companies was there was going to be monopoly legislation thrown at them. They were going to be like antitrust and try to break up the big companies. With Joe Biden in office now and mainly a Democratic House and Senate, I have a hard time believing that they're going to throw the book at the tech companies. The tech companies seems to be in cahoots with the Democratic Party, so I doubt they're going to break them up. And these companies essentially are printing money because literally all you need to do to run Facebook is turn a server on and watch the advertising revenue just stack up. So for using a textbook, tech stocks and high flying companies that have low capital needs are going to be a great place to put money. Cryptocurrency, highly controversial. I was once a non-believer. I became a believer. I'm still a believer, even with cryptocurrency prices down literally close to 50% to where they were when they hit their peaks a couple months ago. Now, if you don't wrap your mind around cryptocurrency or it gives you the heebie-jeebies, just don't buy it. And if you are smitten with cryptocurrency, I would again tell you to curb your enthusiasm. Keep your position in cryptocurrencies from about 1% to 5%. And I'm going to elaborate on cryptocurrency in a couple slides. So a lot of the things I just showed you, you're looking at going, okay, Adam, so we're in an inflationary environment. You want me to put my money in all of these risky assets? That doesn't feel real warm and fuzzy. Because I'm worried about the market crashing. I'm worried about our federal deficit. I'm worried about asset valuations being at all-time highs. So what the heck should I do? So hopefully I can show you some things that it might give you a little peace. So you're right. If you look at a chart of the S&P 500, we're at an all-time high, depending on which day you look at it. But there's kind of a tale of two cities that's playing out within the S&P 500. On the left side of your screen, you'll look at this Vanguard Growth Fund, ticker VUG. It's actually the largest holding we own as a firm, or one of the largest holdings we own as a firm. And if you look at what makes up that fund, the top 10 holdings are Apple, Microsoft, Amazon, Facebook, Google, Tesla, NVIDIA. And the performance of that fund in calendar year 2020, it was up over 40%. Compare that to the right side of your screen. These are boring high dividend names within a Vanguard High Dividend Yield Index, ticker VYM. Top 10 holdings within here: Johnson & Johnson, JP Morgan, Procter & Gamble, Verizon, Comcast, Bank of America, Pfizer. Kind of boring, steady Eddie dividend names. In the year 2020, this fund was only up 1%. Growth stocks will generally outperform value stocks over long periods of time, but they'll generally only outperform value stocks by about 2% per year, not 39% per year. So a lot of people are calling for 2021 for there to be a flight to value. People are going to leave growth names and move their money into value names. They're going to move out of the tech companies and push their money into dividend names. We've already seen that a good bit. If you're working with us, we've already made that shift. Dividend stocks have been outperforming growth stocks in calendar year 2021. I think that trend will continue. And even if I'm wrong, this is what I love about this particular wager. This is Johnson & Johnson's chart over the last 18 months or something like that. If you're a statement gazer, or you're the type of individual who looks at their account every 3 hours, owning a dividend stock is not for the faint of heart. Look at this Johnson & Johnson. This is over like 18 months. It dropped 7%. The coronavirus hit. It drops 21%. It shoots right back up. Right after it shoots back up, it drops 10%. And then it shoots back up, and then it drops 11%. So if you had $100,000 in Johnson & Johnson stock, you would literally see your account drop $7,000 and then gain $15,000 and then drop $20,000 and then go back up $30,000, all in an 18-month time period. It'd be a little nerve-wracking. But anyone who's invested in dividends for a long period of time knows those are simply called paper gains or paper losses. And as a dividend investor, you need to train your eye on these D's at the bottom of the screen that I circled. That means you're collecting a dividend, and our dividend driver model pays just around 4%, a little bit shy of 4% in dividends on an annual basis. So you're collecting a 4% dividend just for sitting patiently and watching your account kind of pop and drop. That 4% dividend is god near 4,000% more than what you're going to make sitting in a brick and mortar bank account. Even a high yield money market account right now is only making about a 0.5 percentage point. So dividend investing makes a lot of sense if you can train your eye on the dividend income and less on the market gyrations. Because if you look at a stock like Johnson & Johnson under a microscope, this is the type of volatility you'll see. But if you squint your eyes and you take a step back, this is Johnson & Johnson's trend line since 1985. It looks like a 45-degree angle. There's going to be little gyrations on an annual basis, but over long periods of time, as the government prints money, that money is going to float to the earth, right? Remember we talked about the snow globe philosophy. And it's going to find itself in the coffers of the businesses that are very best at separating us from our money. Go to the grocery store and look how much money you give to Johnson & Johnson every time you take a trip there. Or go look at your monthly spending allowance and look how much of it goes to Comcast or Verizon or AT&T or some of those names that I just showed you, those dividend names. And when people say the stock market's at an all-time high, I'll say, yeah, sure, the market's at an all-time high because the stock market is a market cap weighted index, especially when you talk about the S&P 500, meaning the companies that are largest have a bigger emphasis on the valuation of the market, right? So Amazon, Netflix, Apple, and Google, and Microsoft, literally just that bundle of names I just gave you represents like 10, 20% of the S&P 500's movement. And a lot of those dividend names are only trading pre-COVID up maybe 10%. Some of them are even lower than what they were pre-COVID. And we've printed 35% more money since COVID. So if we were just looking at this mathematically, those companies should be 35% higher because there's 35% more money in the system. And a lot of those names aren't nearly as high as they were pre-COVID, or up just a moderate amount. So I still think there's value out there. I think some of those tech companies are in bubble territory, right? Especially the COVID names like Zoom and things like that. Now, I shouldn't holler a name out there because I don't know Zoom from Adam. It could be a good stock, but that's the first name I think of when I think of a COVID stock, because everyone stopped meeting face-to-face and started doing Zoom meetings. But there's still some value out there, in particular in dividend names. So we created a model that a lot of our clients have shifted some money in, and I just want to shine a light on it. This is actually an old model. We've tweaked it since then, but it's an array of ETFs and investments that we think are a good place to be positioned for dividend investing. So you'll see the big Vanguard High Dividend Yield Index, and we've got utility stocks in here. The bond position that it does have, it's got about 27% in bonds, but you'll notice those bonds are Treasury inflation protected securities, high yield bonds, floating rate bonds, preferred stock, international dividends. Energy was on sale for a while there. I don't know, not so much anymore. Master limited partnerships, a lot of those are a lot lower, and you can collect huge dividends in those spaces. So if this is of interest to you, just reach out to our office. We can go over our dividend driver model, and we can talk about if you have any of your money positioned into it, or if you want to shift some of your money into this model that we're running in-house. Another model that we run in-house for folks who are very, very skittish is called our CALM model. CALM, C-A-L-M, just as the model's name would allude to. It's designed to be the tortoise and the hare. This is your tortoise. It's designed to just kind of slowly and steadily chug ahead. We sent it over to a portfolio analysis company, and they did a Monte Carlo simulation on it. And they basically said this thing is designed to make about 4.3% per year. And the worst potential loss you might experience in a really ugly market cycle, they literally run it through 100 different market cycles, is it might be down around 6.9%. If you look at the top of this spreadsheet, you can see stable and conservative. A money market or a CD would be way on the left side of stable. If we simply put your money into a bond fund, it would be over there in conservative. So I like to think it's a little bit more conservative than a bond fund, but heck of a lot more aggressive than a money market or a CD. And again, sitting on cash right now is essentially accepting the fact that you're going to lose 2% per year. We even have some dividend stocks within this CALM model. So this could be a place you deploy some of your cash or money market monies where you can have a crying shot at keeping pace with inflation. Again, some of you are looking at going 4%. That's not going to keep pace with inflation. Well, it's going to do a better job of keeping pace with inflation than sitting on a money market or sitting in cash or sitting on a Vanguard bond fund that has a yield of 2% that's actually down year to date. So it's a way in which you can hedge, use things that zig when the market zags to give you some stability and give you an opportunity to make a better rate of return than what you might find in a bond fund or obviously sitting in cash. I'm going to shamelessly plug again our SWAN model. I've done a webinar on this. I've done a podcast on this. Reach out. We're happy to send this to you. You're kind of being baited into buying assets right now, guys. Savers are being penalized. I saw someone did a tweet that basically said, if you were to write a book on Socialism 101, chapter number 1 would say, print a bunch of money, penalize savers, bait savers into going into assets, so things like real estate and stock and cryptocurrency. So bait people into those assets, watch those assets appreciate in value, demonize asset holders, thereby allowing the government to tax nominal gains on assets. Well, if you see this playing out like I see it playing out, I'd rather you be the rich people owning assets than the poor people saying that the rich fat cats are getting rich while you're not. So one of the things that you should own in an inflationary environment is stocks. But I get it. You've been sucker punched 2 times in the last 15 years owning stocks. So our swan model, if you recall, has rules-based algorithmic triggers. So if the market starts to crash and people start to pull the carpet out from underneath of you, there'll be a trigger that'll move you into a safer place in an emotionless way. And is it foolproof? No, it's not foolproof. If Dave Ramsey were on the webinar, he would say, hey, buy an index fund and hang on for dear life. Don't buy and sell your stock. He's probably right. If you're 30 or 40 years old and you have ice water in your veins and you know you're not going to need to gain access to your money for a decade or two, just buy low-cost index funds and hang on for dear life. But the lion's share of individuals we work with are in or nearing retirement, and they don't want me handing them a statement where they've lost 30, 40% because everyone ran for the exit at the same exact time. We like to think our swan model does a very good job of letting people invest in assets in the stock market, but with a cautionary trigger underneath of you, so you can sleep well at night. So a lot of individuals who work with us, most all the individuals who work with us have money in our swan model, and the performance on that has actually been really good. So if you just want to take inventory of how that works, like I said, you can ask us for the webinar we did. We did a whole webinar on the swan model, or you can go to our website, go to the podcast tab. There's a podcast all about swan, or always feel free to call the office and we can walk you through exactly how that thing works. Finally, cryptocurrency. Some of you are already checking out. Some of you, this might be piquing your interest. So I have a unique perspective on cryptocurrency because I was once a cryptocurrency naysayer. I thought it was magical money made out of thin air that was there for nerds to fleece us of our wealth. And there is an element of that. There is an element. There's a lot of what are called altcoins that are truly magical money created by nerds fleecing people of their wealth. Think Dogecoin, for instance, or Shiba Inu, or there's literally 1,000 different cryptocurrencies out there. But the big cryptocurrencies, the biggest by market cap is Bitcoin, of course. And Bitcoin, there's 21 million of them, and there's never going to be any more. Right now, there's about 18.5 million in circulation. And what makes Bitcoin so exciting is I think sometimes as Americans, we're in a bubble. And we neglect to realize how fortunate we are. It's very easy for us to deposit money in a brokerage account with Adam, or it's very easy for us to march into a bank, which litter our street corners, and opening up a savings account where we feel safe that our money is going to, because the US dollar is the global reserve currency, we feel pretty good about our money in greenbacks. Well, that's not the case for a very large chunk of humanity on this earth. People are worried about their reserve currency losing value. Think of people in Venezuela right now, or people in Turkey, or El Salvador, which recently adopted cryptocurrency, Bitcoin in particular, as a reserve. They recognize it as a currency. So I saw a statistic once, and I'm going to butcher it, but they said that a large segment of our earth is unbanked, meaning they don't have money in bank accounts. But an overwhelming majority of individuals have access to a smartphone, right? You think of the people in Africa, for instance. A lot of folks in Africa are unbanked. They don't have access to a bank, but they got a smartphone. Everyone's got a smartphone. So one of the appealing things about Bitcoin is it opens up this landscape as a place you can put money so long as you have a smartphone. And I think what we'll see is people are going to start using cryptocurrency. It's not trading like this quite yet, right? A lot of people think it's going to act like digital gold. Gold still yet usually goes up when the market goes down. It's still a flight to safety. What I've found about Bitcoin is, one, the jury's still out. There's still a lot of uncertainty there. This past week or so, the head of China, I forget what he is, called a premier or something, came out and basically doesn't want cryptocurrency miners under his roof. So you're seeing the hash rate. That means the number of cryptocurrency transactions has dropped precipitously on Chinese soil. A lot of that's because they're going to be unleashing a digital yuan. So they don't want cryptocurrencies that are that they can't regulate happening on their watch. But I think that's generally going to be a good thing for cryptocurrency because that's going to spread the hash rate across the whole world. In risk of me going down an absolute rabbit hole, we did a podcast on cryptocurrency as well. I did one back in October where I was a cryptocurrency naysayer. And then I did one recently where I was a little bit more of a crypto bull. So you can laugh at me for both of those podcasts because the first one, I knew nothing about cryptocurrency. And I had my good buddy, Justin, on the podcast with me, who's very active in cryptocurrencies. And he kind of educated me on how it worked. And then on the second one, I was a bull, and go figure, right after I got bullish, China pulls out of the cryptocurrency game and crypto prices drop precipitously. The second biggest cryptocurrency is Ethereum. And think of Ethereum as the Internet 2.0. Basically, every single application that you hold near and dear, heck, this webinar platform, Facebook, our CRM, our client relationship management software, is going to be built on a decentralized Ethereum blockchain. And what makes it so exciting is when it's built on a blockchain, it becomes decentralized. So there's no one entity in the middle there pulling levers and manipulating the usage of it. And then it's open source. So everyone under the sun who has access to the internet and a brain is going to be able to improve that product. I hate to break it to you, the world's smartest people are not all in Silicon Valley. We've got smart people spread across the entire globe, and these individuals are going to be able to participate in these ecosystems and improve products. Any innovation that has been open source has revolutionized the world. Look at the internet. The problem with the internet now is companies like Google and Amazon and Facebook and Twitter were the first to the party. And they're now starting to lay claim and create monopolies. So where you go on Google, and if you really wanted to look something up that's that's attractive to you, Google's going to manipulate their search data so you get to see what they want you to see. Well, Ethereum blockchains are not going to have that centralized force. They're going to be decentralized. So the products and the services that are truly in humanity's best interest will bubble to the top. Again, I'm not going to go down a rabbit hole here, which I already have, unfortunately. You might have to pull me out of there. But we've done podcasts on this. I would be happy. You can bend my ear, call me up. I can tell you a little bit more about how blockchains work. They are revolutionary. Some people are saying that blockchain technology is on the same plane of technological advancement as the internet and mobile devices. A lot of people are saying the internet, mobile devices, blockchain technology. That's the type of advancement we're talking about with these blockchains. So cryptocurrency right now is off pretty tremendously because of what's going on in China and what's called FUD, fear, uncertainty, and doubt. But I think it's here to stay. And I think it's prudent with the amount of hope that is involved in some of these projects and the amount of hope of creating another global reserve currency that the entire world can tap into with a smartphone. I think it's prudent to look at this as a viable asset class. And again, 1% to 5% max. We've been having a lot of conversations with folks about cryptocurrency. It doesn't quite play inflation like gold does, but it's certainly something that I think should have your attention. I like what Mike Tyson said. This is a time-honored quote. Everyone has a plan until they get punched in the mouth. So you know my shtick, it's have a plan. And I once had a plan. Claire and I just celebrated our 5-year wedding anniversary, and you can see on the left-hand side of the screen, it was me, Claire, and Alice, and really the only problem we had on a day-by-day basis is which restaurant we were going to go to and if they allowed dogs on the patio. And look at the glimmer of hope in our eyes. Like we had it all figured out, and I was going to retire at age 40, and boy, life, the world is my oyster. And then God punched me in the face in the best way he can possibly punch me. There's Ben and Brooks, a 3-year-old, a 2-year-old. And then I don't know if y'all heard, Claire's expecting again in November, and there's a baby girl coming. So I'm sure that baby girl will have me wrapped around her finger, and life has gotten a little bit more complicated. So you know how I like to inject my family in these presentations. So I thought it'd be cool just to do that. Take some time and review your plan with us, guys. Reach out to our office. I'd love to show you some of the concepts that I just shared on this webinar, how we've already implemented them into your portfolio if you're already working with us, if we want to implement more. And for all the folks who aren't working with us and are just kicking our tires and sniff testing us, what's taking you guys so long? Come see what we're doing over here. Come update your plan and come work with us.